Hi, everyone. Hi, everyone. Welcome. And thank you so much for joining today for our session on reducing risk, regulatory and credit risk in digital currencies. Many see digital currencies emerging as a new asset class. Paul Tudor Jones has written about buying Bitcoin to hedge against inflation. Cryptocurrency may, as collateral, may become more prevalent as a recent result of events. And there are a number of new tools and services that have made it easier to address credit and regulatory risk. But the question is this enough? And are digital currencies becoming easier and safer for investors to manage? So in the session, we'll hear from FalconX, LedgerPrime, Digital Gamma on how they view credit risk and regulatory risk. And let's just get started. So first off, let's do introductions. My name's Karen. I'm with BlockchainIntel, and what we do is blockchain analytics. We provide risk reporting on regulatory and credit risk for our customers, and we serve anybody that does trading of digital currencies. Ari, do you want to go next? Oops.
Sure. Hi, my name is Ari Pine. I'm one of the founders of Digital Gamma. And what we do is we provide a tri-party repo product. And the goal of that is to manage credit risk with counterparties, particularly in the crypto borrow and lend market.
Aisha, do you want to go next?
Hi, I'm Aisha. I work at LedgerPrime. We are a quant hedge fund, primarily focused in derivatives, and we're owned by the same holding company as LedgerX.
And Aya.
Great. Hi, Amaya. I work at FalconX. We are a digital asset trading platform, previously at Pantera Capital, and very excited to be here with you all.
Okay, so let's start off with a controversial topic, and that is market manipulation. We just like to start off with the heavy ones. So with market manipulation, we've seen a lot of things recently. Obviously, there was March 12th, but even before March 12th, we BlockchainIntel have been tracking how liquidations have led to lower prices. So, for example, we've seen how a loan has been made when the value of the collateral is high, but then the price drops. And when that price drops, the lender starts liquidating. And as they liquidate, the price drops even further, enabling the lender to liquidate all the customer's collateral. So I know all of you have a story to tell in this area, and want to just hear what are things that people can, why does it happen, first of all, and how can investors protect themselves?
Yeah, so I can jump in. I guess on the market manipulation side, I'll be more specific to at least what we've seen with the market manipulation. So it comes and goes. I would say right now, one of the things that's really interesting is there is a lot of liquidity in Bitcoin. However, we're still at that point where we're still seeing some of that market manipulation. So we saw it March 12th. But we also have seen it, more recently. So, for example, I think early June was one of the latest examples of that. And one way that at least we and I think a lot of our clients have been tracking it is called, at least known as like the infamous BART. So essentially, you'll see a price drop significantly over $500 in the course of under like 1 or 2 minutes. And a lot of that, I think, I can talk about at least the effects of that. And Karen, going back to your point, it definitely freaks some institutional investors out, primarily because in the traditional markets, when you see significant market movements and drops, they'll happen over the course of let's say over 30 minutes. For it to happen under 5 minutes, 2 minutes, it becomes really difficult for people to get in and out of positions. So specifically on the March 12th date, perhaps you were liquidated, but I would say a lot of funds, for example, that we know weren't able to get liquidated out of positions because that liquidity wasn't there on the other side, and the market was moving so significantly. So, Ari, I know you have strong opinions on this with regards to platforms that offer leverage, but the biggest thing for us is always, really assessing counterparty risk of some of these platforms and making sure that our clients are aware of all of those risks before they put on trades there?
Well, thanks, Aya. Yeah, so my background, as some know, is that my background is in trading. I've been a market maker and a prop trader for a long time. And, I guess my take is, if that's what the market is going to give you, sort of like the whole thing, if the market gives you lemons, make vodka lemonade. So if it's going to give you volatility and you know what you're doing, you should be able to take advantage of that, right? Usually the trouble that I see is that people often complain about the volatility, mainly because they don't necessarily have a clear sense of value for themselves. That said, it's really not a sign of health to have certain situations like what you were just describing, to have these big air gaps. But to me, when I see something like that, that's an indication that it would be an involuntary trading event, right? Meaning some sort of risk event where a risk manager is, forcing a trader, whether that risk manager is literally, some person, or whether it's the algorithm at one of the venues, right? And so, what that is a sign of is weak hands that are getting shaken out because they're forced to. And that really comes about when there's a market that is very leveraged. Sorry if you hear the barking, I'm going to close the window. So that's something where I think that if investors in this market want to be able to trade from the side of strength, is to not really engage in platforms that have such heavy leverage where you can get 100 to 1. It's nice. I mean, it's, obviously it creates, to riff off of a panel from yesterday, it creates, very efficient capital. But it has the other side of being very efficient on the capital side is that you end up being very leveraged. And that means that the control of your position goes further into the hands of somebody other than yourself.
So I actually just would like to add quickly to it. I think the fact that, the entire trading landscape or even the entire blockchain landscape isn't as much regulated, we can get away with as much as we do. We don't have power switches. If there's a, 6%, 7% market volume in change, no power switches. It's becoming norm as we go on and go further. Then the other thing is, like, as Aya mentioned on liquidation, one important point to know is that there isn't a lot of real liquidation in this space. There's a lot of wash trading volumes, and most of the volumes that you see on coin market cap on any given day aren't even real. So what is being manipulated at given day, that's basically, and where is it coming from? So unless and until we put some sort of infrastructure in place, more clearing houses, more FCMs, more regulators, not in a bad per se, but in in a good shape and form, I think that's where we can semi-control it. But we do think that we do still have some time to go in it.
Yeah, I actually really agree with both points that were mentioned. 100%. Like, a lot of the work that at least we do in-house is trying to clean the data. Because like you said, there's trying to figure out what's real versus what's fake volume, and pricing is really difficult in this market. My question is relative to clearinghouse, twofold. The first is clearinghouse, does that slow down the process? While I agree completely that perhaps we need something in the middle to make sure things are real when they go through that transaction. What does a clearinghouse look like for us in crypto? And would it slow down the process in the way it does in the traditional sense, where if you're trying to move money from like your Venmo to your bank, it takes 2 days because of this, clearinghouse in the middle that has to manually check all of the different transactions. So that's my first question. My second question is, I always have a lot of questions. My second question is about leverage. If you are a small fund and you don't have as much capital, but you want to get levered up, what are your options in that situation? Because I would say those are the ones that primarily get hurt in a situation where there is that kind of level of market manipulation.
So I'll take your first question, the clearinghouse question, because I think so. I recently just taught at NYU Tandon, and I had to do a lot of technical analysis on each and every single coin, especially the top 5, to teach my class how protocols work and whatnot. And while we were talking about Bitcoin, it was pretty much clear that each Bitcoin transaction takes up to 10 minutes, with the nonsense approval and whatnot. So, so let's take a step back to that, right? Like if we can somehow reduce the transaction per speed, I think we would make, these clearinghouses more efficient. So, as I said, before, that it's a long process to get there, but I think that clearinghouses would have it a lot more easier once Bitcoin has less of a TPS, than what it currently has.
So I'll jump in as well. I don't know whether you guys have noticed or not, but there's been some prime brokerage news of late.
No, really?
and actually one of the things that so I've been giving some thought to that because I think it's very interesting. And not only is it sort of just intellectually interesting, it turns out that actually Digital Gamma, when we started out, was trying to provide prime services. My background also is from traditional markets. And so my initial feeling about many of these things is, why shouldn't we take a look at these models and look at a clearinghouse and so on? And I know this is going to sound really weird after what I just said about all of the leverage and 100 to 1. But one of the things that's really nice, so if to understand what a prime broker or a clearing firm does in the financial markets, the first thing that they do is guarantee your trade, right? So that's the primary thing. They are your representative at the exchange where you're transacting, and they are going to put up the funds and make sure everything clears and settles, right? In other words, they're going to confirm that you did something, and they're going to actually move the money around to actually get it done. If you are no good for that, the clearing firm is on the hook for that. And that's why you see such smaller leverage in the capital markets than you do. I mean, that, and there's regulatory rules about it. But that's one of the reasons why you see much lower leverage than you do at, let's say, BitMEX, where they'll let you go 100 to 1. But one of the nice things about having BitMEX or one of the other firms do this for you is that whereas your clearing firm is going to come after you and say, hey, you didn't have enough money and we're going to sue you and so on, there's this process whereby, if you're in there and you've gotten liquidated, it's not your problem anymore, really, right? So you've gone through this process and you've essentially, in exchange for not paying all of these commissions and potentially some other overhead, you've gotten some benefit out of it. Because even though you're taking on this leverage, and I would definitely argue that 100 to 1 is way over on the wrong side, right? But if you were to be able to get 4 to 1 leverage, maybe that makes a lot of sense. Maybe a distributed prime brokerage model can make a lot of sense, and maybe there's something going on in the market here that is pretty innovative and doesn't necessarily look exactly like what capital markets looks like.
So why don't we turn a little bit to what understanding credit risk means and what that and how that helps making investing safer. And really, if you guys could go into your perspective in that area, what would make investing safer, and really, what does that mean in terms of credit risk?
Yeah, I definitely think the industry lacks a universal credit score, and you can kind of break it out into different ways. But to me, for example, we work with a lot of liquidity providers, and there are definitely times, on calls that we may probably be talking about the same counterparty, where perhaps, we had a bad interaction with them, maybe they didn't settle always on time. And being able to actually communicate that through a credit score would be great. For example, if there was a bad actor that perhaps, did not settle, and then tried to open an account with a different liquidity provider, you could avoid that by either one, communicating, or two, having this credit score. In the traditional world, I would say there's been a lot of issues with credit score. For example, a firm came out to kind of help more on the retail side folks that maybe weren't getting the right credit score, or it was being measured in a different way. So you could say that maybe that would hold people back on the crypto side. To that, there are a bunch of different solutions that at least I've heard that are really interesting. You can either have a universal credit score, you can have a static, something that's dynamic. So essentially a different credit score every day based on trading habits, settlement style, balance sheet, and AUM. And then let's say things that you've seen in terms of on-chain interactions as well, that can all go into play. And Karen, you can probably speak to this as well, but it definitely lacks a credit score for the safety of both the liquidity providers, and I could see it also tying into some of that fake volume as well.
Right.
So one thing like I wanted to make clear, for everyone on this call is that there's a lot of lending and borrowing in the crypto space between different shops, OTC desks, large liquidity providers, and it's primarily on reputation and just relationships. Like I mentioned, there's no credit scoring. There's no formal documentation of how each and every fund stands. So even if clearinghouse is more of a very centralized approach to it, then there are projects like X margin, for instance, or zero knowledge proof, that are decentralized solutions that are currently being worked on that could help with this. So that's where my opinion is at.
Yeah. So I'll add in a little as well, right? It's a very difficult situation when you don't have any real financial information on people. As far as I know, there's not really any widespread audited financials. Obviously, as discussed, there's no credit ratings. There's no obligation to report in some way. And because of what we were speaking about before, and actually listening to both of you in our prep call, you were talking about some of the implied leverage that you guys as firms will sometimes do because of, let's say, T+1 settlement, right? And so between the T+1 settlement and with leverage that you're getting on other exchanges, and not necessarily a way to lock things away, even if you knew somebody's static balance sheet, you really wouldn't know what sort of risks you're looking at the moment. And so that makes it just, in my mind, is really emphasizing Aisha's point, which is you're doing it all by reputation. But, and by the way, chances are people are going to mean well. It isn't necessarily somebody trying to defraud you in these situations, but that doesn't, standard operating procedure in capital markets is the weakest hands are the market makers, not because they're not sophisticated, but because they are, right? So these are the guys that are really optimizing for capital efficiency. They're always, generally the most leveraged because, they're constantly trading, and statistically they should be sound. But as we know, in the long run, there's going to be some 40 standard deviation event like March 12th or whatever. And I think one of the other things to note is part of the credit risk, so long as it isn't totally unsecured and you just hand somebody over stuff, really goes about market risk, right? Because if you're giving somebody T+1 credit, yes, they haven't paid you, but really the most you're going to be out is the difference between where you sold it and where it settles the next day, right? So a lot of credit risk can get transferred back into a market risk scenario because it's a matter of, sort of missing that change between today's price and tomorrow's price, or roughly speaking. So.
Yeah.
Go ahead.
Oh, I was just gonna say you bring up a funny point because we don't have like a balance sheet that's approved by any centralized power, but at the same time, I think in crypto you probably give the most documentation you would in most other industries. For KYC, we get proof of address, we get your proof of ID. So we already have those. Then we're asking for a balance sheet. Then we're asking for a few other things. You might be sending anywhere between like 7 to 10 documents for every platform that you're onboarding. I can imagine it's not very fun. So
I onboard a lot for LedgerPrime, and I can agree to that. It is as much as I enjoyed my tedious efforts throughout life. Yes, it is, and there's so much back and forth because the other party also has to be well aware of your situation, and they're trying to make sure they understand it completely. And again, given the lack of regulations, everyone is like extra careful. So my each and every single onboarding project takes about 25 to 30 emails back and forth without a joke.
Yeah, I'm not surprised.
Dovetail to regulated and unregulated exchanges. To your point earlier, Aya, we looked at a lot at exchanges and reported volume versus on-chain volume, and there was clearly a big difference. And so our indicators will show when there's a gap, where there's a big mismatch between what we see as on-chain transactions, on-chain volume, as opposed to what's been reported, say, on CoinMarketCap or something else. Now, in terms of regulated, unrelated exchanges, there's a big difference also because these exchanges, the unregulated exchanges, don't have the same minimum liquidity requirements as regulated exchanges do. And the other risk that you have on unregulated exchanges is that they're not required to report on money laundering quite as much, or they aren't checked for that. And then as a result, they could be shut down later on for those reasons. So understanding that regulatory risk is important, as well as the credit risk. So that brings us to our next question around how firms are differentiating out today in terms of liquidity, and really, what do you guys think about how your firms and what you guys do to ensure, lowering that liquidity risk?
Me? Sure, I'll take it because of both of them. So I think, from our perspective, we have seen a huge growth in derivatives in past few months alone, which is always a sign of market maturation. And then we've seen players like CME, Backed, LedgerX, which are like regulated exchanges, develop more of a footprint. So I think that's where the growth is, and that's where probably would be a huge interesting point for other institutions to join, real traditional institutions to join. The other thing that Ari touched upon was capital efficiency. Wanted to, make a point on that is that, funds like us, at the end of the day, market makers, but we also have limited access, pools of capital. So we also have to be very efficient on where we're allocating it, right? Like what exchange, what OTC does, where is it, where at the end of the day it's going to go. So that's something that probably would need to change as if we could get more settlement providers, or as we've started seeing mergers at Genesis or Coinbase that have the facility to provide such kind of collateral to funds like us, to trade in larger volumes. So that's where we think the infrastructure would be changing in, upcoming months or so.
I'd like to add just a touch to that in that I'd also say there's a role for regulators to help out in this, to provide a more uniform playing field, because what happens when there is the very unregulated and you have the regulated, people go to wherever the cheapest cost of capital is going to go, right? And that's basically what we've seen, because it's cheaper to operate. And which essentially has the function of pushing out people that are trying to do things the right way, because they're getting less business. One of the, you can argue maybe there are other things, but Gemini is trying to do things the right way, but you see how little volume relative to some of their peers they get, considering that they are trying to do things the right way. And then you start to wonder, well, is it because they're trying to do it the right way and it's just so much cheaper to deal with unregulated, don't worry about the KYC AML, don't send 25 to 30 emails back and forth. So
but can I add one thing to it though? I think that since March 12th, in both my personal and professional network, I feel like people have become a lot more cognizant of where their capital is going. And they rather put it towards a regular exchange, OTC, whatever it is, but they know that it's not going to, diminish overnight in, some accident or so, or some annihilation. So I think that's one perspective that March 12th has changed for a lot of people that that have somewhat survived that in the industry. So that's what I think on that too.
I've heard mixed. So I think for us, most people, and we'll be super open and transparent, but most people who left BitMEX, who got hurt during the crash, I think moved over to Bybit, and that exchange specifically did really well following that. So I think it depends on the counterparty risk people are willing to take. So to your point, Aisha, absolutely. But I think now funds are still looking for a cheap cost of capital. And so maybe now they're going to be more cognizant of how much is left on the platform versus off at any given point in time. But unfortunately, we're still seeing and hearing that people are still exchanging on unregulated exchanges more. So I would say it depends on your counterparty risk tolerance.
So let's go back and talk about crypto-backed lenders now. And Ari, if you want to start off that discussion, and I know Aisha, you had some views on this too. Just what are the companies that are offering loans, and what are the differences, and what does your offering in particular differentiate?
Right. So, some of the pretty well-known ones are, Celsius just, announced that they got $1 billion worth of outstanding loans, and BlockFi are two of the big names, and Nexo. And a lot of how they operate is that you're giving them an unsecured loan in some way, which is to say you're giving them a deposit. And so should something happen, then you've got a problem. Meaning, should they go bankrupt, then you have an issue, just like if your bank has gone bankrupt, you have an issue. The other way that they operate is, for instance, and this is where March 12th really gets into it, is people would post crypto with them and try to get US dollars from them. It would be over collateralized at that institution. And then should the price of Bitcoin drop, then, or whatever the crypto is, should it drop, then they would liquidate it to a certain amount to get back into bounds, right? So that it's still 140% margined or whatever. And that's seems pretty much what kind of caused the second and third waves down on March 12th. And, on the other hand, then you have like some of the DeFi platforms as well. And then in those cases, you are trusting in the process itself, and you're, which has been both good and in some cases been a little bit not so good with some of the issues that they've had. And then our particular platform is a little bit unique in that, or I think a lot unique, in that what we do is there's an exchange of, what we do when you're doing a crypto loan is if, for instance, you want to borrow against your Bitcoin, you would find the other side of the trade. You would transact your Bitcoin versus US dollars, for instance. You would do that on a one-to-one basis. And then at the same time, both parties would be posting margin against that. And so this goes back to the idea of credit risk being market risk. If, for instance, the price of Bitcoin that you've lent out skyrockets and your other side does not wish to pay you back, you, one, have the money that you've exchanged for it, as well as having the reserves in the margin account that we hold in escrow. And so, hopefully, under most circumstances, there will be a sufficient amount of margin for you. That day when, world governments all adopt Bitcoin as their currency, there might be a little bit of an issue as Bitcoin might skyrocket very aggressively. But under most circumstances, the combination of the legal obligation and the escrow should render the situation pretty safe.
So I think that Ari has covered most of the players. The BlockFi, I know, thanks, Ari. BlockFi, Cred, XO, Celsius. When you really think about, loans, you have to think about flash loans. How they've been operating in DeFi, but again, they're not as big of a value as these trading loans in traditional markets or in the CeFi markets are. The other thing is, there is, like I mentioned earlier, there is a lot of borrowing and lending between various trading desks, various funds. In the CeFi space, and that is somewhat sometimes based on collateral rehypothecation, relationships, or just settlement T-1 day. So that's where we see borrowing and lending at.
Now,
yeah, I was going to say that's I'm super happy you brought that up, Aisha, because it's less structured and definitely less talked about as much, but it's still a huge part of borrowing and lending.
and so I want to shift now to the services and tools that make lending and investing safer. Now, in our pre-call, you guys talked about how you said there are a number of products that a trader needs, and it's a lot that you have to manage and deal with. And I know a number of you talked about some data quality issues that you had to manage. Now, so if you could just, each one of you go through, and any one of you could start just talking about the products out there, the services or tools, what the differences are, and challenges that you see.
Yeah, data is a hard issue in this space, mostly because I think I mentioned, like, if you're using SKU, then you're mostly looking in the derivative space. Then you can use other platforms like Kaiku. There's a bunch of different data providers, all really interesting, but focusing on specific areas and at different price points. And so combining all of that to then also create your thesis is a lot of work. Take that in addition to whatever platforms you use to trade, whatever platforms you use to custody, whatever platforms perhaps you're also using to borrow and lend. If it's a different platform, I think I was joking, you may have like anywhere between like 8 to 15 windows up on your screen at any given point in time, which isn't a seamless process at all. And so while it's super great that we're definitely seeing an expansion of all these tools, I'm definitely in the camp of M&A. So as much as we can do to combine these into one screen, and I think that's kind of where the direction of the Prime services is going.
Similar opinion to Aya's, and like I mentioned, like in our prep call too, I did like some extensive research on data providers, and from our fund's perspective, we needed on-chain, off-chain derivatives, other 30 platforms we look at, and multiple elements, and we almost came close to a couple, but then we felt like internally us managing it was a better solution to it. And yes, I do think that merging would be a right thing. And then the other thing is we do need concrete information, even though CoinMarketCap is as comprehensive as it can get, but it doesn't have like the valid information on most days. So, and it's owned by Binance. So yeah, so I think like it's very, very important to put like legit information out and then get acquired by something by someone better. But yes, like Aya said, a lot of information out there, but at this point it just needs to be consolidated. And as more and more trading volume grows, more products come into derivative side. I think by that time we should like have at least one or at least three central data providers to go to.
Yeah, so my perspective is particularly from capital markets or money markets, and be careful what you wish for. I think there are a few people out there that trade on CME that may wish for an alternative vendor, or that there's some competition in what they're participating in. There are plenty of people who find it very odd to pay for market data for their own bids and offers. And then you'd like to think that, after, 40 years of a very high growth financial services industry, that there would be super high quality data. But what can often occur is, the vendors out there are not necessarily always going through, to Aisha's point, is valid data an issue for you, or just having the numbers on the screen is okay. And so, having, a vendor on the other side that cares in the same way that your PM or your trader or your data scientist is going to, is not always as clear. So you still need to do a lot of verification even in capital markets. So just wanted to make that point as well.
Yeah, there's a follow-up for you guys. Since I spend a lot of time in integration and integrating data for capital markets in particular, I saw that there were, yes, maybe 3 or 4, maybe a few more firms that people would tend to use. And then they would integrate this data and manage it themselves. So do you see, and this would be for the large institutions, I would say, and even some of the smaller ones. So do you see that happening as the best practice, that people may choose 3 or 4 different vendors, but they have to vet that data, they have to validate it, they have their own maybe tools internally to pull that data together?
I feel like it depends on each and everyone's bandwidth at this point. Like we've built it out internally. So for us to get a vendor at this point, we would want less work for us and then more work coming from them, because we're a small fund. But it all depends on your bandwidth. If you have a person dedicated for it, kudos to you. But I think most funds probably won't be at that point though.
Mm-hmm.
Yeah, and also the data quality at the source is going to have to step up its game as well. As anyone who's written to any of these exchanges knows, it can be difficult to deal with these. Some are better than others, of course, but you have to be a fairly sophisticated participant to act, especially if you're looking at it from a very high frequency standpoint, and you need it really up to the minute, or not minute, but milliseconds, so to speak. Everything is very distributed, and there aren't standards. It would be really nice if there were some, and I don't even mean just like having a fixed standard. I mean, just even how do you timestamp? You know, are we all using UTC? You know, that sort of thing, right? You know, and you know, and I think we went through the example of, you know, even at one of the top exchanges that has great tech and very reliable, if you happen to be connected to two of their, you know, gateways, and those gateway and you look at the timestamps on trades from each of them, they have different timestamps, even though it's clearly the same trade, because they're timestamped at the gateway rather than at the exchange side. And you know, there may be one or two things that you can learn from, you know, financial markets, and you know, some sort of standardization makes a bit of sense.
Yeah, I'm so happy you brought that up. Timestamp is such a bad, I just don't, yeah, it's so bad how much time we spend just cleaning our data. I mean, it's just not fair, right, Aisha, to your point, for a small fund who's trying to get data from all these different exchanges, that the timestamp isn't standardized. Yeah, it's not fun. If we don't make it easy in this space at all.
Right. You know, it's bad when you're like, you know, in one of the biggest up and coming, you know, businesses in, you know, since the interweb, and, you know, you know, on this show, right, we're sitting there going, boy, man, if only I had good timestamps.
So for the rest of you, as we go into our last couple of questions here, feel free to send in your questions through the chat. We want to definitely have feedback for you in your specific areas that you want to address. Now, I did want to turn and spend some time on regulatory issues, because that has been a hot topic before. Not one maybe that everyone wants to think about, but certainly something that we do have to consider. And one of the areas that I just want to touch on a little bit is the travel rule. So for those of you who don't know about the travel rule, it was originally established to track money laundering and bring bad actors to justice. Now, the senders and receivers of virtual currencies must submit customer details when a transaction is greater than 1,000. And in the US, these customer details have to be shared when the transaction is greater than 3,000. So this travel rule has been in effect in the US, and FinCEN has said they expect all virtual asset providers to be compliant with the travel rule. And if the firms don't comply, they will have, and they will continue to fine, as they have before. For example, there was a $700K fine against Ripple Labs. Now that includes companies that exchange fiat to cryptocurrency or cryptocurrency to cryptocurrency, as well as custodial services that manage private keys on behalf of their clients. And what I've been hearing a lot from our customers and others that we talk to is that the travel rule doesn't apply to me, or I don't know when it does apply, or is this something that I have to worry about now if we have to wait till everybody else gets on board? Now, the issue is, for those of you in the US, it is something you have to deal with now, because FinCEN has made that very clear. And FATF, which is the Financial Action Task Force, a global organization, has made sure that all the countries know they have to enforce this. And they're reviewing the level of enforcement, the level of regulation around this issue this month. So it is something that is upcoming or will be regulated, if not already. And I've talked to a number of companies in this area who have questions about it. So if it is something that you're looking to or haven't heard about, happy to send more information about this, as well as point you to other resources, including those on this call who have joined. Now, just a question back to you guys. I know regulation is your favorite topic. Is there anything you want to talk about in this area? Just highlight something to note, watch out for, something you'd like to see.
Sorry, go ahead.
Sorry. So, go ahead, Ari.
I just wanted to say the same point that I had before. I would really like to see a level playing field where, you know, where if we're trying to do the right thing, and I know you guys are as well, not having to compete with others who are, you know, going offshore or whatever. And you know, anyway, that's my hope, is that it's a level playing field, that there's a set of plain rules that can be followed, and everybody's following that same rule book.
Agreeing with Ari, definitely for sure. Some sort of infrastructure to provide that level playing field. I think investor protection is extremely important. We need, more funds, more players in the space to bring in, the liquidity that we all are hoping for, to take this landscape and onto the next level. And I think for all of that, it's important if there's some sort of investor protection involved at this point. And then like I mentioned a couple of times, infrastructure, it's extremely important.
Okay. If there are any other questions, please enter them in the chat. And if not, do you guys have any questions for each other? I know I had a bunch initially.
We only take controversial questions.
Yeah, it has to be something interesting.
Otherwise, we can go back to the question of who's going to be the big prime broker.
Oh man, sorry. My favorite.
Actually, so if no one else to answer that question, we do have a question from the audience. Would love to actually understand how your respective organizations go about counterparty risk assessment. If there's no credit score and limited disclosures as discussed, what are ways you protect yourselves from exposure? Also interested of who you see playing a role in standardizing those disclosures. For example, proof of reserves for exchanges. Who should lead that?
Great question. Really, really good question. Yeah. So like Ari mentioned, we do T+1, and I think most liquidity providers, that's industry standard. So you take on that 24 hours of risk with whatever limit you provide to a client. And for us, it's there's a few things that like our risk committee will assess, but at a high level, it'll be balance sheet if we need to. It'll be on-chain, any sort of on-chain analytics if we have them. It's also going to be understanding, first of all, their the trading platforms that they currently use, their trading strategy. Are they a momentum trader? Are they a market neutral trader? So those are some of the higher level things before we kind of dive into the analytics. And then for us, really the biggest thing, we start all of our clients on pretty low limits and then ramp them up as they're settling. And so that at least is super important for us. In terms of, you asked a really good question. Who is going to be the company that kind of all of the players trust to make that assessment on counterparty risk? And honestly, right now, there hasn't been a player that has basically announced, like they're going to take that on. There are some companies that are doing a lot of interesting work on like X margin, for example, with zero knowledge proof, where you don't necessarily need to exchange the documents, the files, the data, and the company can do it on behalf of the client, which I think can be really interesting. But right now, there hasn't been a neutral party that has said, we're going to take this on. I could easily see it being one of the settlement rails that on top of settling will also help with counterparty risk. That would be a really easy integration. But that's then there's a few other independent players. Yeah.
So that's the problem that we try to address with Digital Gamma, right? So our answer is more or less, or quite a bit more. The answer is math, right? We can make some pretty good predictions about what tomorrow's going to look like, right? And so to get back to Aya's T+1, her risk when she's extending that credit is not so much whether that person pays her or not, but if, for instance, if she sold Bitcoin at 10,000, if it drops to 9,500 and they don't pay, her risk is 500, right? So that is a, sort of this idea of credit risk being a function of market risk. And how can we translate that in? And can we take the math and make good business decisions from that, right? It's not going to completely eliminate, what is going to happen or the potential for credit risk, but we can really mitigate it by having this escrow in our case, right? Where somebody is going to post some capital as security against performance. And so if you say put 20% against your, in our case, borrows, then, and you rebalance that every day, so long as Bitcoin stays within that 20% band, it doesn't matter whether the other counterparty makes good or not, right? We still expect that they are. There's still a legal obligation to do so and so on. But really, we're reliant on the math, and that takes a good chunk of the risk out of it.
So for us, the counterparty risk is the exchanges where we trade on, and the OTC desks that we work with. Like I said, a lot of it is driven by relationship, reputation, and then due diligence done on both sides. It's like we have to pick our players, our partners as we go on, and with time you kind of like realize who's a better partner in in OTC or in an exchange. Like I said earlier, regulated exchange kind of like favor this a bit more than unregulated because we know our collateral is safe there. So that's where the risk is for us.
Yeah, and going back to that, you can even boil it down like, is a counterparty waiting the full like 23 hours and 30 minutes until they settle? Are they settling like 30 minutes after they traded? Are they settling once? Are they settling multiple times and able to flip through their balance sheet? So I think there's a lot of small things, Ari, to your point too, just math that you can kind of figure out to almost internally calculate someone's credit risk.
Right. So it sounds like you're almost working toward an idea of almost like Amazon ratings for counterparties,
Almost. Yeah.
Right?
Almost.
Were you happy with the delivery time? Did they put it in a good package,
Was
right?
the product okay? Was the Slack channel or Telegram handled well? Yep, that's what it's boiling down
but then
to.
we start rating like, was the blockchain swamped, and so like no one got their delivery on time. So.
A lot of traffic.
Yes. So another question here from the audience: with more capital entering the space, do you expect more competition with new prime brokers? You got your prime broker question. Dark pools, ATSs, and some traditional banks chasing the institutional pie. Do you have any concerns around conflicts of interest, i.e. exchanges owning prime brokers? Any R&D on a crypto-focused NBBO?
I think if exchanges or if large lenders or if large trading desks are owning or if are heading towards more mergers and becoming like a full service provider, that's a good thing for the industry because then they have like a larger pool of a capital than these smaller shops that are floating around. The other thing about dark pool is, so far I've been at LedgerPrime since November and I've only come across one company, and everyone keeps saying that it's the next big thing. I still have to see more. I've only come across one. I would love to see more and see what we can do with them. And prime brokers, more players better, so more consolidation as we go along. And then the other thing is, there's always going to be a winner. There's always going to be a right product market fit, and someone is probably going to take a lead on getting most customers. So I think that's where I know Shield. Shield is the only one. I spoke to them during consensus. Yes, the only one. So
nice on the fly adjustment.
Yeah.
Well done.
So I think yes, people like Tigo. So someone earlier today mentioned, the example of Tigomi and Coinbase, that Tigomi launched earlier, raised the right capital, but couldn't find the right customers. And then going to Coinbase is probably going to give it more market exposure. So more and more products is actually a good thing for the market. But one thing I want to add, though, one thing that I have learned ever since joining LedgerPrime, there are more service providers than trading desks at this point. So, which is a good thing and a bad thing. Influx of products are great, but then we also need to have, again, regulations, infrastructure in place to attract, the traders. So I think that's where the focus should also be.
Yeah, that's a great point. It's a loaded question, and I would look at it first. Is there more demand even coming into this space? And what demand is it? And so I think you can definitely see that there's been a huge retail uptick in demand. $6 trillion got pushed into the economy. Coinbase emphasized that they had new accounts that were constantly churning with retail flow. So that's a completely different product, retail product, than it is for maybe a mid cap or a large cap fund. And each one's going to be trading really different. If you're a market neutral, like a small ARB trader, you're going to have completely different needs than if you're a momentum trader and you're taking on these large positions because you truly believe in the future of EOS. So it's going to be really, really, really different. And because of that is why we've seen so many different providers. There are some providers who really, really focus on these like small cap cryptocurrencies. There are larger providers that are the best at, your top 5. And then there are other providers who are like, okay, if you are a systematic trading fund and you're only doing APIs, we're the best for that. If you're a mix of a few, we have an offering for you. So yeah, it definitely becomes, Yisha, to your point, really overwhelming as a trader to go through all these. One thing I would say too is there's a huge difference between if you're a principal dealer and an agency dealer, dependent on if you're a lit pool or you're a dark pool with how you are currently organizing and offering liquidity to clients. And so that's one thing I would notice. And then relative to PB, everyone I've spoken to has a different definition of what prime broker means to them. And it's very different than what prime broker is in the institutional market. And so like in the traditional market, you have your investment bank and then you have your prime broker. In crypto, it's all prime brokerage for us. And PB has been this magical word. But what does that actually mean? Some people are approaching it from a lending position and adding a trading desk, which could look really different. Some people are approaching it from custody and trying to do lending and trading, which kind of enters the question of rehypothecation. Some people are entering it from perhaps they, are in the derivative space. Now they want to do spot. Now they also want to provide leverage. So that's a different question completely as well. And some people, as mentioned in the question, are entering it from the exchange space. My only question there is if you provide liquidity, how comfortable are liquidity providers going to be with sharing their proprietary liquidity with you in the hopes of not getting priced out by the original liquidity provider? So all really interesting questions that I guess we'll see who and gets there first is also really different because dependent on the client base that you're focused on, success is going to look different for everyone.
So I think Tagomi is probably one of the most interesting stories, right? I mean, they have this great group. There is a ton of dough. And I think that, coming at it from a capital markets point of view, right, you think, and this is a great quote from a friend of ours, and he said, everybody's trying to solve a balance sheet problem with technology. And right. And so, everybody, exactly. So it makes perfect sense. But I've been thinking lately that maybe that's not necessarily the answer, right? And this goes back to what I said before, but maybe there's distributed prime brokerage out there, right? Maybe we have some of that because what are you going to a prime broker for? Generally, it's because you need most of the entities that you're dealing with in traditional finance require an entity that will guarantee trades. That isn't the case in crypto, right? Partly because you're dealing with unregulated or partially regulated institutions. If you're going to deal with CME, you have to have some sort of a prime broker, right? Whether you call it a prime broker, a clearing firm, an FCM, whatever you want to call it, somebody has to be a clearing member of the exchange and guarantee you. In and if you want to integrate all of those things together, you certainly do need that. Not everybody necessarily wants to do that. But I think that one of the reasons why there's been a dearth of customers for what people have looked at to be PB is because crypto found a way to do it on a distributed basis via these other exchanges, whether it's Kraken futures or whatever, where you can get leverage and you can get many of the features, a little bit over here and a little bit over there, and people sort of cobbled it all together. And so they didn't really feel a need, and maybe even know that they were supposed to feel a need to go get a PB.
Yeah.
So I think that's also a pretty interesting question. And I think it's just something that, is worth taking a look at. Because maybe we've created in crypto something that's a bit hybrid and maybe even a bit improved, right? A lot of traders go to prop trading groups in order to get financing and in order to get protection from, blowing out, which is to say not only losing all of the money that you actually have, but then, money you don't have. And so they often go to prop trading firms who do that. That isn't necessarily something that you need in crypto, again, because of these liquidation procedures that everybody complains about. And believe me, I certainly have too, and I can understand it. But on the other hand, maybe it's bringing something that's a little bit different and perhaps more valuable than we initially think, just maybe not at 100 to 1.
Yeah, I want to build on that. Actually, I obviously have a lot of opinions on this topic, but I think competition is great. Like, this is the best case scenario that you could possibly want as someone who trades in this space, because it means that we're going to be building products fast, and that's what competition does. Literally, years ago when people wanted to trade crypto, there weren't exchanges, right? So the question was, how do I get liquidity for this thing? And so you had OTC providers come in, but they were servicing some of these larger tickets. And then you had hundreds of exchanges pop up all over the world. And then they all got acquired. And there were, a few, maybe let's say 10 really large players that kind of came out of that. The same's going to happen probably with PB. But, there's still a lot of questions that we have not figured out as a group, as an industry, whether it's credit score, whether it is cross-margin collateralization. I mean, this is like the biggest question in the industry that no one's really figured out at scale. If you're trading on a derivatives platform and you have collateral there, and then you want to trade on a different platform, because none of us talk and we're not, super close friends just yet, we don't want to, we're not going to let you cross collateralize. And so then you have to collateralize somewhere else, and now you're double collateralized. And that to me is just really bizarre. So we have a lot of work to do. But this is good. It's healthy.
So we have one final question here. What's the standard today for how crypto traders benchmark and assess execution quality, and how do they, and when they choose between different providers?
Good thing. Okay, so what's so again, this is the theme of our topic today. Credit risk and regulations and whatnot. So how do we select our providers? So from my personal perspective on LedgerPrime's behalf, the ones that we work extremely closely with are the ones that, are prompt, efficient. We have a great relationship, with them. We settle on time, and, they're always there for us. That's, those are the service providers we're working with. And as far as exchanges go, 90% of our positions are in futures. So Deribit, LedgerX, CME, again, all regulated exchanges. We know that, our positions are secure. We know that, we somehow are, investor protected at most, given days. So that's what we're focused on, relationships, and then knowing that we have some protection out there for us.
Yeah, I don't think Deribit's fully regulated.
Not fully, but they're not as they don't have as bad of a reputation as some others.
And so I don't know that I would definitely defer to Aisha or Aya on TCA, but I would tend to think that one of the things that needs to be solved for that, it goes back to the data question. So it's really hard to figure out whether or not you're getting a good fill if you don't even know with certainty what the market was, right? I mean, it's rather difficult. Again, it comes down to those timestamps.
Yeah. Yeah, data is just the biggest game changer really in this market. I don't feel comfortable answering this question mostly because I am a service provider, so I'm a little biased. But to all the points that were earlier said, 100%, you know, if you can provide good data, great execution, and good pricing, I would think that's, and, you know, settlement responsiveness, I would think that that's what your decision is based on.
Okay, well, with that, I want to thank our panelists and thank all of you for joining today. We look forward to our next one where you can come and also ask your questions on these topics here. So please stay tuned. We'll have a recording of this. We'll send it out and provide any associated links that are of interest to this topic, for this topic. And we look forward to the next session with you. So thank you for joining, and we'll see you soon.
Thank you.
Thank you.
Thanks, Aisha. Thanks, Aya.
Bye. Thanks,
Thanks, Aaron. Thanks, Aisha. Thanks, Ari.